The Treasury market seeing a wild ending to the first half. Let's bring in on-air editor Rick Santelli for some context. Rick, I saw a stat that the 10-year bond specifically had its worst half since 1788. I don't know. I know that you weren't around. I'm not trying to make a joke about this, but that's a long time. And I'm wondering if you can give us the context in terms of where we are for yields here in terms of support levels, and what do you think are the fundamentals driving it at this point?
Well, my own feeling is that we could have, in many ways, seen what the run rate is going to be for the Fed. The high rate, the normalization rate, in my opinion, was going to be around 3.5%. And if you look at the quarter to date of two-year got up to very close to around, 245 intraday, 243 on a high close mid-June. Look at quarter to date chart on 10s. They got up to, 348, 349 on a closing basis mid-June. So I think that 3.5% is something definitely to keep in mind. In terms of the Fed and what they need to do, they have a lot of extra help that most people don't even know about. Today the big news that nobody talked about was that the reverse repo facility, that parking lot for all that money, reached $2.34 trillion. Big deal. What does that matter? Because you know what? That means the Fed tightened again. How? Everybody says, what do you mean the Fed tightened again? Where do you think most of the money in the money markets and most of the cash in the entire economy, the M1, 2, 3, you know where they're all going? They're all going in that parking lot. $2.34 trillion worth. That money used to be in margin accounts that were holding stock positions or in accounts holding treasury positions. But now, basically, it's a no duration, no credit risk. You get 155 basis points, and it's just drawing the money in. I think rates are going to suffer from the economy suffering, and the economy is suffering. And I fully suspect in 3.5 weeks, we're going to get a very low second quarter GDP. Will it be negative? I can't tell you, but Atlanta Fed now doesn't look all that terrific. And finally, look at Boons. We could learn a lot from Boons. Boons on a quarter to date, well, they closed at 134 today. Less than 2 weeks ago, they were at 177. They closed the quarter at 55 basis points? I guess what I'm saying is Treasury yields have zoomed, as sovereign yields have zoomed, but now they're all starting to float back down. And that's the part we need to pay the closest attention to. And truly, the Fed could talk as tough a game as they want. Inflation probably did peak, but that doesn't mean prices are going down. And that's going to be the new topic in about 9 months.
Hey, Rick, it's BK. So you set me up perfectly on the inflation. So, there's a lot of studies out there that'll say, with inflation, let's call it even if it gets to, CPI was 8%. Let's even say if it gets down to 5 or 6%. The Federal Reserve, the ECB, all these central banks have said, listen, we want positive real rates. So if prices stay the same and or go up a little bit, and we have CPI come down to 5%, but 2 years still at 245, doesn't the Fed have to raise an awful lot more here just to even get those real rates that they've already told you they want, those positive real rates?
I want a Ferrari, BK, but I'm probably not going to get one. The Fed wants real rates. The ECB wants real rates. Risk Bank want real rates. But in the end, they're a lot more real at the levels you're talking about, even though they're negative to inflation, than they were just a few years ago. I think the issue that is going to dominate Fed thinking and Fed strategy is going to be jobs, jobs, jobs. And I think we're still clinging by a string on creating them, but I think that the runway for that is getting real short.
Hey, Rick, it's Tim. You're the guy that knows the answer to this. We hear all the time about all these foreign investors in the U.S. bond market that are going to run for the door. Our dollar, your problem, our treasury market, your liquidity. Talk about that, because if that ever changes, some of these technical factors could outweigh the fundamentals.
It's been something we've always worried about since day one, and now we're aiming in various directions, pointing at entities that we are pretty sure aren't going to be stepping up to the plate, like the Federal Reserve, probably not going to be buying. The QE days, at least for the moment, are over. I don't worry about that. I still say at the end of the day, the U.S. markets are the best, cleanest shirt in a dirty hamper. We've used those analogies and metaphors over and over in the last 7, 8, 9 years, but it's true. So I think foreign interest is going to resume, and I think it's going to continue. And even if it drops down, and the Japanese are my biggest worry, because the Japanese probably aren't going to be able to afford to be such great customers. But in the end, if you look at all the investments the Japanese own, Ours are probably the only ones they're making money on right now when you consider their stock market peaked 44 years ago.
Wow. Rick, it's always great to have you on Fast. Good to see you.
Thank you.
Rick Santelli. Brian Kelly, I want to go back to you in terms of what you're asking Rick, because I think it's an important point. I mean, your point basically is that if we don't see any progress on inflation, the Fed is actually, and we see rates continue to go lower, the Fed's going to actually have to hike a lot more.
Yes, that's exactly my point. And the reason why is I think they've already lost the fight on inflation. The BIS had a great report out last week where they talked about when you have a 20 to 30% rise in commodities like we had in the first quarter of this year, inflation a year from now is 1% higher. So we've already lost that fight. We've got government stimulus checks coming from Europe, Great Britain, California, likely here in the U.S. once we get to the midterms. Demand is not going to go away. Therefore, you're going to have this demand out there. You're going to have tight markets, and prices are going to go higher. And the lower that rates go, the Fed has told you this. We want real positive rates, and that means they want the interest rate to be above the rate of inflation. And I don't think they care about jobs yet at all. That's the government's job, they're saying. So I think they're going to have to raise interest rates an awful lot to try to tame this thing.
I get the BIS study that you cited, BK, but how does that jive with the five-year forward break-evens, which have dropped to levels we haven't seen since pre-pandemic? I mean, that indicates that the expected inflation is actually going to be lower. And so, you know, you have this setup here where maybe historically you've seen inflation play out, but then the expectations that we're seeing right now priced into the market are that actually inflation has peaked.
Right, but I would say that they're wrong about that, right? We saw this in the 70s. This is exactly what played itself out in the 70s. Everybody thought inflation peaked. Well, I mean, that's where we're at. We're in this stagflationary environment.
And back in the 70s, you forget, I mean, BK had the hair wing back. He had platform shoes on. He had, he had the big lapels.
And a onesie, because that's how old BK is.
Yeah. Exactly. Platform shoes and a onesie. I still have the onesie.
Yeah, I was just going to say, when you think about where rates are and where they have to go, the point is that the central banks, specifically the Fed, are going to have to toe the line. And we've been talking about, kind of this stagflation environment where, like, the Fed can't be cutting rates anytime soon. The problem here, though, is that the inflation's not even from commodities, it's from the labor market. The labor market, which structurally had to change, and I think there's a lot of really important social things that really we can't factor into where labor is right now. But labor had to go higher. That has not fed in. That is enormously sticky, and it's inflationary.